The most dangerous number in the financial system right now isn't a stock price or an inflation print or a bank headline, but $9 trillion. And that's not a one-off, 4% of GDP. Those numbers are so large, they stop feeling like budget lines and start behaving like gravity. Because once interest becomes one of the biggest expenses, the system changes character. It becomes less about what a government wants to do and more about what it must finance. What makes this moment different is the speed at which the stress shows up in market plumbing. Not months, not weeks. In 48 hours, the precious metals market can flip from record highs to forced liquidation, not because the world changed, but because the financing terms changed. On Monday, December 29th, 2025, precious metal futures dropped sharply after the CME Group raised margin requirements. Gold fell roughly 5%, and silver fell about 8% in a single session. And for silver specifically, reports noted the margin on the March 2026 contract was raised by about $3,000, taking it from roughly $22,000 to about $25,000. That is not a headline. That is the clearinghouse adjusting the rules of participation. They said this could never happen. They said the world would always absorb U.S. debt as the risk-free anchor, that the system would always find buyers, that the plumbing could handle any volume forever. But the data shows something else entirely. Institutions already understand what the math implies, and they position with balance sheets, not speeches. What I'm about to lay out isn't hype, it's pattern. The numbers are the proof, the dislocations are the signal. And the precious metals response is the market's way of saying that confidence can erode quietly right up until it doesn't. Welcome to Vault Signal, where we decode the debt system and the metals market using hard data before the story gets packaged into comfortable explanations. If you've been here before, you know we don't chase rumors. We track incentives and mechanics, and if you're new, consider subscribing the way you'd keep a wise elder close by. Not for excitement, but for orientation. Also, comment where you're watching from, because this story is global even when the numbers are stamped US. Now let's talk about what actually happened, because the crisis is not a single explosion. It's a chain reaction that shows up across markets at different speeds in different forms. In February 2026, the Congressional Budget Office updated its outlook for fiscal years 2026 through 2036. The headline is simple and brutal. 8% of GDP, 4 trillion, 6% of GDP. There's a detail in those projections that changes how to interpret everything else properly. Interest spending is projected to be the third largest item in the federal budget in 2026, behind only Social Security and Medicare. Interest is projected to exceed defense spending every year of the outlook. And interest costs are projected to consume 19% of federal revenue in 2026, rising to 26% by 2036. That is the moment when finance becomes policy. Because once you owe that much and rates matter that much, you don't get to pretend markets are a sideshow. Markets become the operating system. And here's the central tension. The bond market is expected to be the safe reservoir for global savings, while also being the funding source for deficits that are historically high even without a fresh emergency. If those two roles collide, something has to give. Either yields rise to attract incremental buyers, which increases interest costs and worsens the deficit math, or policy leans toward suppressing yields, which pushes savers toward alternatives. That fork in the road is why precious metals keep returning to the conversation, even after painful corrections. They are not reacting to a single news item, they are reacting to policy constraint. Before we go deeper into gold and silver, notice the players touching the same story at the same time. The U.S. Treasury issues the debt. The Federal Reserve sets the short end of the curve and shapes expectations for the long end. Primary dealers and large banks' intermediate auctions make markets and provide leverage across asset classes. The CME Group controls margin and clearing for futures that anchor reference pricing. And then you have the physical hubs, the London Vault ecosystem that underpins much of the unallocated market, the COMEX warehouse network that reports eligible and registered stocks, and the Shanghai Gold Exchange, where physical demand is expressed through an onshore benchmark. Add in refiners, fabricators, jewelers, electronics and solar manufacturers, and you get a chain where price is not just a number, but a set of delivery options, financing terms, and custody rules. When those pieces are aligned, price discovery looks smooth. When they're not, you get dislocations that feel irrational unless you understand the plumbing. Here's a quick example of how that plumbing transmits stress. Treasury issuance increases the supply of duration the market must absorb. If yields rise, funding costs rise across the system, including for dealers who finance inventory, and for hedge funds who run relative value trades. Higher funding costs tighten liquidity. Tighter liquidity makes volatility more expensive to carry. And when volatility becomes expensive, the first thing that gets sold is whatever is most leveraged, most crowded, and most sensitive to margin. That's why you can see what looks like a paradox. The long-term driver, deteriorating fiscal math, can be bullish for the idea of hard collateral, while the short-term mechanics, rising margin and tighter funding, can be violently bearish for leveraged positions. Both can be true at the same time. The data doesn't argue with itself. It separates time horizons. And watch how quickly the system transmits stress across asset classes. A bond sell-off doesn't stay in bonds. Higher yields feed into mortgage rates, corporate borrowing costs, and equity valuations. Those moves influence portfolio rebalancing. That rebalancing spills into commodities, and then the commodity moves feed back into inflation expectations, which then feed back into bond yields. It becomes a loop. In loops, volatility is not an anomaly, it is the natural output. Take ETFs as a bridge between public markets and physical custody. A fund like GLD or SLV doesn't single-handedly set the global price, but it provides a liquid on-ramp and off-ramp for large pools of capital. When flows move into these vehicles, shares can be created by authorized participants. When flows reverse, shares can be redeemed. In many structures, that creation and redemption process is tied to metal custody and bar lists. So during volatile episodes, you can see an odd split. Price whipsaws intraday while custody levels lag, because the financial layer repositions faster than the physical layer can move. In early February 2026, published fund data for the iShares Silver Trust showed total silver in the trust around 1,691 tons as of February 9. That's not a forecast. It's a snapshot of custody. It matters because it shows the warehouse of convenience in the financial system is still enormous. Yet it can change quickly if flows turn and liquidity demands shift. Now connect that to the leverage side. Futures are not fake, but they are different than physical. A futures contract is a standardized promise. It is marked to market daily. It is supported by margin. And margin is what turns volatility into forced behavior. When the exchange raises margins, it's like raising the minimum down payment on every position overnight. The underlying metal did not change. The financing terms did. If a trader can't post the extra cash, the position must shrink. That is forced selling, not a change of belief. That's why margin hikes can create abrupt price drops that look like a narrative reversal, even while long-term fundamentals remain. This is where the December 29th move is so revealing. Raising the March 2026 silver contract margin from about $22,000 to around $25,000 is the clearing system saying the swing risk is too large for the previous leverage to be tolerated. And the market then does what markets do under tighter leverage. It de-risks fast. Think of it like a theater. Most nights, people sit comfortably and the exits are just a background detail. But if the exit signs flash, the behavior changes. The fastest people out are often the ones who can't afford to stay. They aren't mysterious. They are mechanical. Now, layer in geography. In a unified market, metal is metal and price is price. In a fragmented market, price reflects access. If import licenses tighten, if local demand spikes, if transport and refining constraints create friction, then a bar in one place can command a different price than a bar somewhere else. That's why late January reports of Shanghai Gold Exchange premiums around $30 to $32 per ounce over London spot mattered, especially during a period when global prices were correcting. A premium is the market's way of saying the local bid for immediate physical is higher than the global paper reference. With that framing, gold's behavior in early 2026 starts to look less like a strange spike and more like a repricing of what reserve means. 40 per troy ounce, a new record settlement. Not a rumor, a settlement. In plain terms, a market that is usually dismissed as a relic was being repriced as a balance sheet asset again, but almost immediately, the market showed you the other side of the story. Repricing is not a smooth line. It is a series of squeezes and flushes. When leverage builds, the market can rise faster than it can hold. Then the clearing system forces a reset. That doesn't make the underlying signal disappear. It just reminds you that the path is violent. Now let's step back and find the hidden pattern, because the most useful thing you can do in a moment like this is to stop treating it as unique. In the 1970s, after the US closed the gold window, the world experienced a decade of inflation shocks and credibility shocks. Gold's price behavior was not random. It was the market's way of pricing the loss of a hard monetary anchor. The late 1970s and 1980 peak are a reminder that when expectations break loose, hard assets can become a kind of unofficial referendum on policy. In 2008, the crisis was different in form but similar in essence. Confidence in institutions cracked. The response was extraordinary intervention. Rates went to the floor and stayed there. Balance sheets expanded. Gold responded because it absorbs the consequences of credibility strain and balance sheet expansion. In 2020, another shock hit, and the scale of fiscal and monetary response reset public expectations. The system learned that massive deficits could appear overnight and be financed as long as a backstop was implied. Once a system learns it can do something, it tends to do it again, especially when the alternative is politically painful. Now look at 2026. The baseline deficits are huge without a fresh emergency. 0 trillion in a single year, 7 trillion by 2036. Those are not temporary rescue numbers. They are trajectory. And when trajectory becomes visible, institutions adjust. This is the part most people miss because it isn't loud, it's incremental. It's embedded in balance sheets. In 2025, central banks bought 863 tons of gold, according to the World Gold Council. That is official reserve behavior, not retail coin demand. The National Bank of Poland was the largest buyer for a second consecutive year, adding 102 tons in 2025, lifting its holdings to around 550 tons, with gold around 28% of its reserves. Pause and consider the message. A central bank is deliberately increasing the share of an asset that yields nothing in nominal terms. It is doing that in a world where bonds yield something. That is not ignorance. That is a preference for an asset, with no counterparty risk, no default risk, and no political permissions required to hold it. And it isn't just one country. When central bank buying stays elevated for multiple years, it suggests a strategic shift in reserve composition. It suggests that the global reserve system is being quietly diversified, not because a press conference declared it, but because the risk calculus changed. Now bring silver back in, because silver amplifies the contradictions. Silver is both monetary metal and industrial input. It participates in inflation hedging psychology, and it participates in manufacturing reality. That dual identity is why it overshoots in both directions. It can run harder than gold in a bull phase and fall harder in a deleveraging phase. That dynamic was visible in 2025, when silver's rally was described as more than a doubling from around $30 to nearly $80 before the margin-driven reversal. When the CME raises margins, it is not making a statement about silver's industrial demand or mine supply. It is protecting the clearing system against defaults. The effect, however, is to force leverage out of the market. And forced leverage removal hits silver disproportionately because silver is the metal that speculators love to overfinance. This is where the paper versus physical dislocation becomes unavoidable. Paper claims can expand quickly. Physical supply moves slowly. When confidence is high and funding is easy, the gap is tolerated. When volatility rises and funding tightens, the gap becomes the story. In early February 2026, a cluster of market trackers and analyses highlighted COMEX registered. Silver inventories around the 102 to 103 million ounce range. At the same time, some analyses described March silver open interest representing hundreds of millions of ounces in paper exposure, with figures often cited around 429 million ounces. You don't need to adopt any dramatic conclusion to understand the tension. Registered inventory is the category readily available for delivery. Open interest represents exposure that can be closed financially, rolled forward, or in some cases brought to delivery. If only a small fraction of holders seek delivery, the system can manage it. If a larger fraction seeks delivery, the system depends on conversions from eligible to registered stocks, on sourcing metal, on cash settlement incentives, or on time. That is why inventory classifications and delivery windows matter. Now, let's put the evidence on the table as cleanly as possible. 2 trillion in net interest over that decade. 1 trillion by 2036. Interest is projected to consume 19% of federal revenue in 2026 and 26% in 2036, or 4% of GDP. Reserve evidence. Central bank net purchases totaling 863 tons of gold in 2025, with Poland adding 102 tons and lifting holdings to around 550 tons, with gold around 28% of reserves. 40 on January 29th, 2026, a record settlement. Then a margin-driven deleveraging episode around December 29th, 2025, with gold down roughly 5% and silver down about 8% after CME raised margin requirements, including the March 2026 silver margin raised by about $3,000 to around $25,000. Dislocation evidence? Late January reports of Shanghai premiums around $30 to $30 per ounce over London spot during a period of global correction, signaling a divergence between local physical bids and global paper reference pricing. And for silver, persistent attention on registered inventory around the low 100 million ounce level versus much larger paper exposure. Now, what does that imply going forward if the pattern persists? Historically, when interest costs become one of the largest lines in a sovereign budget, three broad outcomes appear again and again. One is fiscal consolidation, spending cuts, tax increases, reforms, and a political push to reduce deficits. It is clean on paper and hard in practice because it concentrates pain. Another is financial repression. Policies that keep yields below inflation for extended periods, transferring wealth from savers to borrowers. This can happen through regulation, through central bank balance sheets, through incentives that funnel institutions into government bonds, or through a mix that looks technical but functions like a quiet tax on capital. The third is a credibility event, not always a default, often a repricing, a sudden jump in term premiums, a currency adjustment, a policy pivot, or a market accident that forces intervention. These are the moments when assets assumed to be stable behave less stably, and hard collateral regains status because it carries no counterparty. Consider 3 conditional scenarios, not predictions. In a conservative scenario, deficits remain large but stable, growth muddles through near 2%, and rates drift without crisis. In that world, metals can remain volatile because the background fiscal pressure keeps insurance demand alive even as positioning gets flushed repeatedly. In a moderate scenario, yields rise further as issuance increases and interest costs crowd out. Other spending, raising political pressure to manage rates. That is when markets begin to price policy constraint. And historically, hard assets tend to benefit from the perception that real returns on paper will be managed down. In an aggressive scenario, a shock hits and policy responds with stimulus layered on top of an already large deficit base. That is when temporary becomes permanent and trust and discipline erodes. Historically, that's when metals can move in step changes, not because anyone guarantees an outcome, but because the denominator of value is being questioned. Again, none of this is a command. It's conditional logic. If deficits remain near $2 trillion and interest costs keep climbing toward $2 trillion per year, the system will seek ways to manage that load. Historically, managing the load often means reducing the real burden over time rather than paying it down directly. And that is the environment in which precious metals keep returning as a signal, even after brutal corrections, which brings us to the divide. On one side are people who watch headlines and assume stability until the system announces instability. On the other side are people who watch the mechanics, deficits, interest costs, margin requirements, reserve flows, and physical premiums. The difference isn't being smarter. It's paying attention to the parts that move first. Institutions move first because they have mandates, models, and access to funding that retail doesn't. A central bank adding 102 tons of gold in a year doesn't do it with a viral post. It does it quietly because the long arc of risk management matters more than the short arc of price charts. An exchange raising margin requirements isn't trying to predict price. It is protecting the clearing system. But in doing so, it forces a redistribution of exposure from the leveraged to the liquid. That's why sudden drops can occur right in the middle of long-term repricing. The market isn't contradicting itself. It is revealing layers. So here is what to watch, in a way that stays grounded in data. Watch the ratio of interest costs to federal revenue, because it tells you how constrained policy becomes. Watch how often exchanges adjust margins in metals, because it tells you when leverage has become too large for the system to tolerate. Watch whether central bank gold buying remains elevated, because it is the clearest institutional vote that does not require a speech. Watch physical premiums and delivery stress indicators because they reveal when paper reference prices are drifting away from real-world access. One last indicator that often gets overlooked is volatility itself. The CME publishes volatility indexes like CVOL for silver. And when implied, volatility spikes while inventories are tight, it tells you the market is paying up for protection. Pair that with delivery notices, warehouse reports, and the shape of the futures curve. That's when dislocations become headlines fast, everywhere. The question isn't whether volatility continues. The debt math virtually guarantees friction. The question is how the system resolves it, through discipline, through repression, or through an event that forces a repricing of what safe means. This is Volt Signal, where we decode what matters before its headlines. If this connected dots you hadn't seen on the same map, you know what to do. And if you want the next layer, the mechanics that tie debt stress to currencies and credit, stay close. The story doesn't end when price bounces. It ends when the system admits what the numbers have been saying all along.